Bitcoin it's digital energy, right? This is a big idea. We've encrypted money, right? It's such a huge idea. Since most people don't know what money is, it doesn't occur to them that money is energy. Since they don't understand what money is, they don't really understand that money's defective, that the energy is bleeding out of their currency. And by the way, if money is energy, the energy finds its way into a currency. It also finds its way into stocks and into bonds and into property. They're all bleeding energy over time or over space. And if you're an engineer and you understand that a well-engineered system is a system that allows you to move energy through time and space with no power loss, no impedance, superconducting, which is that we call that like it's an adiabatic system or a thermodynamically sound system. If you're an engineer, you totally get it when you're designing a pneumatic system, electrical system, even a heating system in a house or a swimming pool. If the water drained out of your swimming pool, wouldn't work so well, right? If your bathtub, drained out, it doesn't work so well. So engineers understand this, but economists don't really think of money as energy, and so it doesn't occur to them that the energy is bleeding out of the systems. Once you figure that out, you realize that Bitcoin is truly brilliant, because what they've done is they've created a thermodynamically sound monetary network that allows you to store any amount of energy for any period of time and move it at essentially no cost anywhere in space as frequently as you want. And inflation and diversification are both bromides. There are these simplistic terms that people toss around, but no one really thinks very deeply about them in my experience. I mean, let's start with inflation. Inflation is not 2%. Inflation is not the CPI. It's not 7.5%. Inflation, properly understood, is simply the rate at which the price of anything appreciates in the currency, which is the frame of reference, which means that you can calculate an inflation rate for a Picasso painting, which is different than a building in New York, which is different than a bond, which is different than a market basket of goods and services that you wish to buy, which is different than the market basket of goods and services I want to sell you. So what's the real inflation rate? It's a vector, right? It's not a scalar. A scalar is like 2%. No, it's not. It's like an n-dimensional vector, and there's a different inflation rate for everything in every place for every time period, dynamically evolving, right? Once you understand that, you realize that there's probably two inflation rates of interest. One inflation rate is the rate at which cost of living is going up for a middle-class family. That's not the CPI, because the CPI is a manipulated market basket set by a politician or a bureaucrat that is engineered not to go up in price very fast. Most average people would find that their inflation rate is higher than the CPI. And if, for example, we don't include the cost of buying a home in the CPI, even though it stands to reason that just about any reasonable person would want to buy a house at some point in their life. So you can calculate a consumer inflation rate, which is different than CPI, but you can also calculate an asset inflation rate. That's the cost of getting rich or staying rich. If you want to be wealthy, it's not good enough to keep up with CPI. You have to actually keep up with the rate at which assets are appreciating, right? The cost of housing went up 18.8% year over year. That's Case-Shiller, according to the Case-Shiller index, right? That's another. That's a common asset. But if you look at the S&P index, which is a market basket of desirable companies, that gives you a surrogate for a monetary inflation rate. The monetary inflation rate's been running 7 to 10% a year in the U.S. at the same time that the CPI has been running 1%. If you understood that, you understand that your cost of capital is more like 10%, which meant that any investment you made that didn't yield 10% was making you poorer. You were losing wealth. Any business person understands that. I couldn't get you to accept a 2% ROI on an investment. So if you understand inflation's a vector, then you start to realize that the inflation rate in Miami Beach is different than it is in Kansas City. and you understand that the inflation rate, if you want to stay wealthy, is much higher. The inflation rate in 2020 was about 25% for assets. The inflation rate for bonds was at one point higher, right? You could have bought a bond for $1 million that yielded $50,000 in interest a decade ago. If you wanted Social Security, if you wanted $50,000 in income risk-free the rest of your life, the cost was $1 million. When the 10-year yield went to 50 basis points, you would have to pay $10 million for the same bond. The bond went up by a factor of 10. What's the inflation rate? Right? The inflation rate in that particular case was 100%. It was like hyperinflation. You had hyperinflation in the bond market. You had massive inflation in the asset market. You had no inflation in the Domino's pizza delivery, Netflix market for a while. And if what you want to do is live in your parents' basement and watch Netflix and order pizza, then the inflation rate much, much lower for you. And if you wanted to stay wealthy, or you wanted to get wealthy or hold shareholder value, inflation rate looks more like 30-40% in like 18 months. So once you understand inflation is a vector, then you stop paying attention to just one cherry-picked number, because what you realize is I can manufacture any inflation rate you want simply by adjusting the market basket of products and services. And by definition, if I never include assets in the market basket of desirable goods, then you will always ignore asset inflation, which is the most pernicious inflation. So we have had hyperinflation since 1971, but the inflation has manifested itself in the assets. And here's the pernicious thing about it. I've literally brainwashed you into thinking that asset inflation isn't a bad thing, it's a good thing, and it isn't inflation at all. It's actually investment gain, right? So that's when I convince you that a bad thing is a good thing, right? We've come to a bizarre point. So we're living in inflation since we went off the gold standard. It's just manifests in the assets. We have hyperinflation right now. It's just manifesting itself in the assets more so than in the goods and services. Now, if you go to diversification, it's another bromide, another silliness. You should be diversified. Lots of people say that. A lot of times the people that say that to you want you to give them your money, right? It's like I'm a hedge fund manager, and so I'm going to stand up and tell you need a broadly diversified portfolio of like international equities and domestic equities and like some of these commodities, and it changes all the time, and it's very complicated. It's too complicated for you to figure out, so you just give me your money. I'm going to charge you a 2% fee, keep 20% of the upside, and I'm going to invest it in this hyper-complicated array, diversification of stuff, right? I'll give you a simple idea. Go buy Bitcoin. Don't give me anything. I don't want your money. I don't want the 2%. I don't want 20% of the upside. And Bitcoin is a diversified index of the entire world economy, and certainly the crypto economy as it comes to its senses. You can believe one thing or the other thing. You can imagine if you're in the business of managing people's money, the last thing you want to do is tell them the answer is just buy this one thing and hold it for 100 years.